Last week's surprising rate cut caused much commotion amongst economists, but what does it mean for the housing market? We caught up with Savanth Sebastian at CommSec for his views. Sebastian says there's no doubt this rate cut will help the housing market, but he is looking out for long-term improvements too.
There's no question that this rate cut will really drive that housing sector to another leg in terms of momentum. It will probably lift house prices as well once again. The key here is we'd like to see an ongoing improvement in building new construction of homes rather than cannibalising the existing marketplace. So housing, I think, is really going to get another leg of support from this particular story. We've got strong population growth, a first home buyer market that has been struggling to get into the property space, and I think overall the one area of the market that you can be sure that will support the growth story, well, is the housing sector.
Things do look positive off the back of November's record number of dwelling starts, but does Sebastian expect this to continue?
There's no question there will be an ongoing lift in supply. We expect that building approvals to build new homes, well, that will continue to lift. We'll probably see something in the vicinity of over 200,000 new homes being built over the next 12 months. So very solid lift in supply, but the demand side of the equation's there as well. So still property price growth of, something like around 7% year-on-year growth, still strong, but easing from the heady levels that we've seen.
Sebastian says the RBA has been firm that if they spot signs of an asset bubble, they will take action, and predicts that macro-prudential tools may be brought in this year.
I think the Reserve Bank made it very, very clear if they see an asset bubble, they will be pushing other avenues to try and curtail that property market. Those macro-prudential tools, I think, will come into play this year. They will certainly look at avenues to try and ensure that the banks lend responsibly to customers that should be borrowing. And in this environment, it may mean that if you start seeing certain customers with not enough of a deposit, they may actually have to start paying a higher level of interest. So you'll probably get a difference over the year in owner-occupied interest rates compared to investor finance rates, something that we haven't seen in a couple of decades, but that's really what we're going back to.
Finally, Sebastian says it's hard to predict the RBA's next move, but says he can't see rates dropping below 2%.
I think the Reserve Bank statement on monetary policy highlighted that, every decision from now on is a live decision, something that we haven't seen, as you mentioned, for 18 months. Looking forward, though, we'd expect the next rate cut in May. I think once we get to just before the budget, particularly coming into the fact that you'll start to get a bit more data coming out, another round of inflation data, I think that's when the Reserve Bank will look at whether the rate cut is warranted. I think the economy would really have to take a turn for the worse for the Reserve Bank to go out and cut rates below 2%, potentially one further rate cut, but they're fast running out of ammunition as well, and if the global economy took a sharp backward leg, well, then the Reserve Bank would have to cut rates further, but I think 2% seems to be the low for the cash rate.